Welcome to the Genius Factory. Enjoy the video.
The U.S. national debt exceeded $1 trillion, driven by decades of annual deficits and compound interest. To understand how it grew, break the problem into repeated deficits, occasional large shocks, and persistent spending programs that outpace revenues. Major drivers include wartime spending, recessions like 2008, and long-term entitlement growth that expands programs such as Social Security and Medicare. Tax policy matters. Tax cuts, such as the 2017 law with about $5 trillion projected cost, reduce revenue and increase borrowing when offsetting spending remains unchanged. When annual spending exceeds revenue, the government runs a deficit and issues Treasury debt to borrow. The Treasury sells bills, notes, and bonds to investors to finance gaps between receipts and outlays. Those instruments have maturities from weeks to 30 years. Investors buy Treasury bonds domestically and abroad, keeping yields low but accumulating obligations that must be refinanced. As the stock of debt grows, interest costs now total hundreds of billions per year, increasing future financing needs and limiting options for fiscal policy. Reducing debt requires higher taxes, lower spending, faster GDP growth, or deliberate inflation to shrink real obligations. Each choice has trade-offs. Policymakers can prioritize deficit reduction immediately or phase in measures over decades to avoid sudden shocks. Policy choices are politically contentious, so reforms to Social Security and Medicare face resistance that complicates implementation. Practical options include gradual fiscal consolidation, targeted entitlement reform, and pro-growth investment that raises
Thanks for watching. If you found this helpful, don't forget to like and subscribe.